What I'll do now is to talk about the application of the amortised cost method to a financial liability. The example I'm talking about now is Paul Cosmetics, which is seeking to raise cash in order to expand its business and does so by issuing bonds on the 1st of July 2016. The bonds have a face value of $5 million, a coupon of 8%. The coupons are paid annually in arrears. The bond has a term of 3 years, and at the time of issue, the market interest rate for bonds of a similar risk is 10%. The first thing we need to do is determine what is going to be the initial amount we initially recognise as the liability. This is the fair value of the bonds at the date of issuance, and there are no transaction costs here. So we can see that we have three cash flows. The first two are the coupon payments, $400,000 each year, and the third payment is the principal plus the third period coupon, $5.4 million. If we discount that at 10%, we see that we have a net present value and a fair value of the liability of $4.751 million. We also need to work out the allocation of the payments to principal and interest components, and we do this with a table which looks like this. I always call this a present value table, and you can see that it starts with an opening balance, which is the fair value of the financial liability at inception. We have the coupon payment of $400,000. We have interest calculated at 10% on the opening balance, and so that gives our interest expense. And the difference between the coupon payment and the interest expense is an adjustment to principal. In this case, we're effectively capitalising $75,000 worth of interest, and so that gives us a closing balance of the liability of $4.826 million, which is the opening balance for the next period. And we simply repeat that over the 3 years of the bond. Please note that I'm arriving at the face value of the bond in the bottom right-hand corner of the table, and that is encouraging me to keep the termination payments separate from the periodic payments. It just keeps things simpler. So what's the accounting look like? Well, initially we'd recognise the liability when we entered into the contract. So here what we have is we'd recognise the receipt of cash of $4.751 million, and would recognise a financial liability for $4.571 million. At the end of the first year, we'd recognise a coupon payment of $400,000 cash, and we'd recognise an interest expense of $475,000. The difference is effectively capitalised interest, which would add to the value of the bond. Year 2, row 2. Year 3, row 3. And so what you can see is that we've simply allocated the periodic payment between principal and interest, and yes, the allocation to interest to principal can be a negative number. Finally, we're at the end of the life of the bond, we'd repay the bond, so we extinguish the liability of $5 million by paying over the face value of the bond, which is $5 million.